Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is Karl Dasher, President of Polen Capital. Welcome, Karl.
Thanks, James. Good to be here.
Great pleasure to have you. Karl, how does the outlook and the state of global credit markets right now compare to what you've seen at other times during your long career?
Well, it's a great time to be investing in credit. I mean, it's probably the best time I've seen in my career going back 30 years in terms of what we are receiving in terms of return premium relative to the risk we're taking. Now, that may sound odd to people, given that we're in an environment where people are concerned about the Fed, concerned about recessions, concerned about various profit contraction. But what we're actually seeing is that creditors are getting a larger share of the economic pie, and that many of the things that were conceded during the zero interest rate policy period, where creditors are being squeezed, has been in reverse. So, as a credit investor, this is a great time to be putting capital to work. It's a great time, especially if you're a pension fund and you have very long-dated liabilities and you have the ability to match those liabilities against the opportunities, versus if you're a bank where you have shorter-dated deposit-based liabilities which are under siege by the Fed. So I think it's one of the most interesting times in my career to be in credit.
The economic backdrop is doing its best to stay resilient despite rises in interest rates, and a recession probably looks, or arguably looks, less certain than it might have done a few months ago. So in that scenario, what sectors and even geographies look best in terms of corporate credit outlook?
Well, we tend to look globally, and we find opportunities around the world. We're very, very idiosyncratic, and we very much focus not just on sectors, but individual companies within sectors. So I can't sit here and tell you that there's any single sector that looks more attractive or less attractive to us from a credit perspective. What I will tell you is that more than ever, it's really important to make sure that you have a margin of safety and you're not having to give up a lot in terms of yield advantage to get that margin of safety. And what I mean by that is, we're looking for companies that have, good recurring revenue streams, strong barriers to entry, good business models, where they had the ability to carry 5 or 6 times, EBITDA and debt, because their enterprise value is going to be, 10 plus. What you don't want to do is you don't want to be in companies and opportunities where you're investing in companies with 5 to 6 times debt, where there's high volatility of revenues, high volatility of operating leverage, and the valuation may be 7 times, where you're extremely close to being 100% of the cap structure. So when we look globally, we find opportunities everywhere. We see things in the US, obviously, the biggest and deepest market in the world, especially in middle market opportunities. We're finding some interesting things in Latin America, where there are companies that have dollar-based revenues. They issue in dollar-based jurisdictions like New York law, and yet we're picking up another 200 to 300 basis points of yield premium for those types of securities. So kind of a guilt by association. I could go on for a long time and give you a lot of answers around the world. Europe is particularly interesting right now because there's a bit of a dislocation in terms of supply need from borrowers versus the demand absorption from pensions, insurance companies, and banks. So we see great opportunities everywhere.
Are yields in some sectors and rating bands approaching equity-like returns?
Well, overall, what we're seeing right now is that, for example, in our flagship strategy, where we cut across both public and private, say right now it's about 15% private and about 85% public, but where it's very idiosyncratic, very concentrated, say about 80 to 100 securities, we're seeing a running yield of close to 12%. And if you think about equity returns over time, they rarely over 10-year periods compound in excess of that. So you're already getting equity-like returns with better downside protection in a lot of these areas. There's ways to enhance that further. You could go further into the private domain. You could go further afield in certain areas. There's some areas in Asia that I would say is guilt by association, just because the shadow of China has kind of clouded all of Asia. But there's a lot of great opportunities there where you can pick up another 300 to 400 basis points with good companies. So right now, it's really hard to make an argument not to be in higher yielding credit if you're looking at it from a total return perspective versus other assets.
What's your sweet spot in terms of ratings bands, or is it that as an idiosyncratic investor, really it's your own work and your own rating, and that you in fact arbitrage that against official ratings?
Well, you've actually hit the nail on the head on how we think about the world. We're fairly agnostic. Now, a lot of clients will put us into certain constraints around non-rated and ratings bands on lower ratings, and we'll work within that. So, but that will have implications for the total return that we can deliver. You know, our general view is that ratings agencies have an impossible job, and they're trying to fit every single company and every single industry and every single jurisdiction into one homogenous sort of classification system. That just doesn't work that way. Nobody asks equity investors to do that, right? But they try to ask credit investors to do that. And so it creates a lot of arbitrage opportunities where, you know, a 6x levered company, regardless of how good the company is likely to be rated CCC. And yet when you dig into those 6x levered companies, there's very wide variances in terms of the enterprise value of those companies, one versus the other, and the stability of the business and the stability of the cash flow. So that tends to be a perpetual hunting ground for us, where there's a guilt by association in terms of leverage ratios. You always, from time to time, get tactical opportunities. Earlier this year, we saw tactical opportunities in shorter duration or shorter maturity issues in the first lien market, where, you know, some structural dynamics in the CLO market were creating very high IRR opportunities on shorter maturity paper. That kind of played out a bit, but we think that could come back and forth in the market over the next few years. Put it in perspective, it was about an 18% IRR on first lien paper with 50% or less LTVs. That doesn't last long, but you see those things come through time and time again.
Are you seeing pressure on credit ratings generally, given that a lot of corporate borrowers might be struggling to pass on increased input costs through to their customers?
Absolutely. I mean, the direction of travel with ratings agencies is to lower. You know, generally, pretty much across the board. There's a few folks who we are seeing improve. I mean, Ford just recently got a positive increase, and that's one of the bigger names in the index that we happen to be in that we benefited from. But the reality is that the majority of issuers, the trend is in a downward direction because interest costs are becoming a bigger and bigger percentage of their revenue base and of their earnings base. So that's something you have to be really careful of, and it's really important to understand the term structure, who has the ability to see through the cycle to the other side, who's going to be forced to refi at an inopportune time, and who's going to be forced to refi at a time when it's not only inopportune from a cost of capital perspective, but inopportune from an operating earnings cycle perspective. So you got to be really cognizant of that when you're placing your bets.
Does Polen prefer, say, the fallen angel theory, or does a rising star philosophically suit you better?
Well, we operate in both. We have, we've certainly taken advantage of fallen angels over time. There's not a gigantic fallen angel move like we saw in 2009, 2010 yet that could occur. Certainly not from investment grade into high yield like we saw in that time. We are generally an organization that will always look for a yield advantage. We tend to try to generate a yield advantage of 200 to 300 basis points, 2 to 3% above and beyond the broad high yield market. And most importantly, we try to retain as much of that yield advantage as possible through the legal structuring, the credit structuring work that we do. And we've done a good job of that. Our default rates are in line with the broader market, but our recovery rates are almost twice that of the broader market. So we retain a lot of that. Those fallen angel opportunities and rising star opportunities, we'll exit the rising star once it gets to the point where the market really appreciates it and the yield advantage is gone. We'll leave that security and we'll go somewhere else where the market is not as studious as we are in terms of understanding fundamental value.
What personal attributes does Polen look to employ? I'm asking that question. I often ask people in the interest-bearing space, could you convert an equities person to your kind of space? Is it just a different mindset? But with you, I want to ask, could you even take a sovereign person and turn them into a credit person?
Look, I've seen a lot of people who have some I guess flexibility or ability to move across. I think that you take sovereigns for example. If you're an emerging market sovereign analyst, you're a credit analyst because you're looking at hard currency credit. You have to look at the ability to generate that. So you're first and foremost a credit person. It's very different than somebody who's an interest rate specialist, for example, trying to parse Fed notes and determine the direction of travel and how that's factored in the curve. So those tend to be quite different. I think that ultimately, when you look at equity versus credit, equity investors are very often driven by the residuals and the multiple increases. We're always driven by free cash flow. Free cash flow is king. Can you service the debt? Can we make sure there's enough of an equity buffer there so that in the worst case scenario, we get repaid? Because from a credit investor perspective, the risk is so asymmetric. It's really hard to make up a bad credit pick because if you get it right, you get your yield premium plus you get par back. If you get it wrong, you can lose 100%. On the equity side, if you have something that really goes poorly and you lose 40, 50, 60%, you might have another offset in a portfolio that's up 200 or 300%. Yeah. We don't have that in credit unless we're buying in at distressed levels. So I think that the risk framework has to be quite different, and therefore what constitutes a concentrated portfolio in credit is very different than what constitutes a concentrated portfolio in equities. You can have a concentrated portfolio in equities that's 25, 30 stocks. In credit, a concentrated portfolio might be 80 to 100 securities.
I've been going in depth with Karl Dasher, President of Polen Capital. Karl, thank you very much.
Thanks, James.